Welcome back, and thanks, as always, to Walter for his fascinating insights in global markets. And of course, we're joined now by Rashaad Tayob, Portfolio Manager at Ford, and on the Nedgroup Investments Stable Fund. Rashaad, thanks so much for joining us this morning.
Thanks, good to be here.
I'm not as close to the strategy as my colleague Neil is, but he has shown me that the slides, or at least your slides, speak a little bit to performance to start off with, and achieving that CPI plus 4 target had already been achieved in the recent periods, which have started to kind of pull those longer term numbers with it as well. But of course, you're better to speak to performance and yourself.
Yeah, so let's kick off with that. Our aim is to deliver that CPI plus 4 return, but also not lose money over a rolling 12-month period. And throughout the history of the fund, we've achieved that. So the last quarter was quite a positive month, a positive period for the fund. We've been able to deliver ahead of CPI, ahead of peers. We haven't been negatively impacted by the volatility and the drawdowns that you've seen in the equity markets, and some of the strategies that we've had in terms of minimizing our exposure to the overvalued US equity market, having a more diversified portfolio has worked quite well in the last quarter. And obviously, if you look at the longer term numbers, those are looking quite good as well. If I move directly onto the attribution in the shorter term of 3 months to 1 year, what we're seeing is that over the last quarter, the foreign assets, which are a big component of the fund, have delivered well. As I mentioned, we're not overexposed to some of the more overvalued sectors of the market, which is why they've delivered. Another nice driver has been other assets. That's primarily the position that we have in gold, which has averaged around a 5% type position. It has been growing in the fund because the performance of gold has been pretty good. On the cash side, that's delivered. And then on the bond side, we've seen yields tick up over the last quarter. So that hasn't quite delivered, and that's also impacted on the property market. But the local equities have also delivered reasonable returns. So I think we're getting returns from a range of different areas. The foreign side specifically, which was a bit of a drag last year, is starting to come through. So quite happy with that type of positioning.
I think gold has served you well. Whenever I look at the gold price, I obviously get excited about your fund to a degree. You speak often about gold. If I think about the use of gold through time has really been quite limited in terms of maybe in electronics, but its function has really been a store of value. I guess that's how you see gold in this world, especially in these moments of uncertainty and volatility, as that store of value. But has that position, have you kept it pretty stable for the last while? Have you looked to raise some of that given recent headlines?
So I think gold serves two important functions. As you mentioned, store of value. So if you look at long-term being able to keep up and be ahead of inflation, historically gold was the monetary asset. It's only in the last 50 years that we've moved towards more fiat currency. So gold has served purpose for many centuries, and I think it will continue to do that. And it's also a great risk-off hedge. And you've seen that in the last quarter when equities haven't been performing, when bonds haven't been performing, gold has actually come through and delivered positive performance. So obviously with the run we've had and the speed of it for going from $2,000 to $3,000 in a short space of time, the question is, are we looking to now take profits, maybe trim that allocation? And on balance, when we've seen a strong rally, we have trimmed it a bit. However, when you look at the role it plays as an alternative monetary asset in a period where the dollar is under threat, in a period where geopolitical risks are actually increasing, we do believe it still has a very significant part to play in the portfolio.
I remember seeing quite an interesting chart not so long ago of South Africa's position in gold production globally. Middle of the last century, I think, was by far the biggest producer of gold. I think we've obviously got a little bit lesser in that global pie. I think China might have even been the biggest producer today in terms of gold. So we could chat a little bit about the geopolitics in a second, but I want to move on to the news happening on the other side of the Atlantic. I think it's very tough to ignore at the moment. There was a headline, or at least a piece written by the editor of The Economist, where when Trump was giving his big spiel in the Tea Garden, saying that it was deluded in terms of his economic policy, his economic history and political history was off the mark. He was spouting drivel, and these are not my words, these are their words, some very strong words. But I know you have some observations on what's been happening.
So it's been an extremely volatile period, on par with what we've seen during COVID, maybe during the financial crisis. If you look where the VIX is above 50, it tells you that there are stresses in the market. There's a lot of uncertainty. And when you see Trump come through very aggressively with his tariff proposals and the impact that has on the market, as you said, a bit delusional. So so I understand the strategy in terms of the manufacturing base of the United States and potentially the world. Look at the impact that China has had on South African manufacturing. A lot of the manufacturing base has been hollowed out, and they do want to reverse some of that trend. But to do it in such an aggressive matter, I think you might end up killing the patient at the same time. So I think not only is the strategy a little bit unrealistic, but I think also its implementation is also not necessarily, I don't think tactically it's the right way to go about it. And you've seen him having to effectively, the tariffs came into effect and they were only in effect for 9 hours, and then he had to basically trim them down and put a 90-day pause. And in fact, even in recent days, we've seen tariffs go up against China, but then a lot of exemptions because they realize the economic ramifications. So I think that when you look at the globalization we've experienced over the last 3 decades, the fact that global trade has gone up from 5 trillion to 20 trillion in the last 2 decades, it's really fundamental to how this global economy functions. And I think if the plans that Trump had initially put in place, I think you would find that the US recession odds would have quickly gone to 100%, because you would have almost guaranteed a recession if he had kept that plan in place, which means that a lot of his plans in terms of reducing the deficit, keeping the economy afloat, would not have been able to be implemented.
Yeah, I mean, on that topic of recession, I think JP Morgan, when all this news came out, I think they upped their probability of recession from 40 to 60%. I think that was global recession, not just US recession, although I stand to be corrected on that. So quite a stunning and a very fast reaction from the markets.
Yeah, and they had to later in the day reverse it back down to 40 because then he postponed the tariff. So the uncertainty in the market is quite extreme, and I think it will remain quite elevated. I think people have talked about the fact that Trump, the power to implement taxes and tariffs should be with Congress. Trump's used emergency powers to take over that responsibility, but it shows you the reason why it shouldn't be with the president, because it is too volatile. Even if you wanted to bring manufacturing back, by having such volatile policy, companies need to make plans on multi-year horizons, even decades. But if you want to manufacture things in America, advanced technology, these are 5 and 10-year plans. So I think you need a lot more constructive policy, a lot more certain policy before you get the manufacturing and maybe the high-tech sectors coming back.
Yeah, and I guess depending on which side of the political spectrum you sit in the US, if you're on the red side, you say this is a very well thought out strategy. It's all part of his big bargaining. So he's bringing this business mindset to governance, which is fascinating. Whereas if you're on the other side of the fence, you'll say there is no strategy, and they're kind of making it up as they go. And like you say, the VIX is probably reflective of that latter. But moving on to that topic of recession with JP Morgan, Goldman's, all of these big banks and their sell sides coming up with renewed numbers, and I think they're looking at their desk daily and probably revising things daily in their models, etc. But I'm interested to know, we often speak about the equity market, but what's happening in the fixed income space, because I know there's been quite a reaction in the high yield at different geographies around the world as well.
Yes, so one of the goals of Secretary Bessent was to bring bond yields down, because we know that the US has a very high debt level. So the US went into this with a relatively weak hand, I think. When you look at their $2 trillion deficit, their 120% debt to GDP ratio, I think going into that, there was some the economy had already started slowing, so there was already some downside risk. And when you saw the downturn in the S&P, the Treasury bond yields did rally, but very mildly, 20, 30 basis points. And in fact, a few days later, bond yields were actually higher. So what we've seen is an upending of the flight to safety trade, which we've known, where as soon as volatility increases, as soon as the markets sell off, people rush into Treasury bonds. This time it didn't happen, and I think that was quite a shock to the market. At the same time, you see in credit spreads, this is the spread on high yield bonds in the US, in Europe, in emerging markets, and you can see that's moved up quite significantly in a very short space of time from very low levels. And I think the important part here is this is where the transmission mechanism from economic uncertainty, from trade policy, begins to impact the financial markets, tightens up liquidity, tightens up credit, banks become hesitant. Bond issuance in South Africa, we've seen Standard Bank, Hyprop cancel their bond issues because obviously the market's too volatile, spreads are too wide, they can't actually issue. You've seen a similar thing in the US where the market starts tightening up, And that's the rise in credit spread, the higher yields are the transmission mechanism where you go from a slowdown to a financial freezing up, a financial crisis, and then you get a very severe recession. So we're paying a lot of attention to that market, the bond market, yields and credit spreads, to see how deep this impact of this policy uncertainty is going to be.
And then I imagine the CDS market is probably the inverse of that as well, so a similar indicator. But in terms of currencies, when you mentioned the Standard Bank bond, when these global corporates, for example, are looking to issue something, do they then start exploring other currencies that are maybe sort of your risk-off style currencies?
So I think what happens in these, what we've seen is quite extreme, and I think what happens is everyone just pulls back. So no, you go out and they want to do a bond issue and they've announced the date, but they realize on a given day it can't actually get done. There won't be any bids in that market because liquidity becomes so tight. So we're in that period at the moment, and I think the fact that the reprieve has come from the 90-day exemption. There's been a reprieve on electronics out of China, which is a big backing down from Trump, and that's calming the markets a little bit. So maybe things can normalize a bit, but I think we're in a very uncertain period, and these risk premiums will remain elevated. And we have to look through a lot of this noise, because when tariffs are changing, almost daily, we've got to say what's the end goal. And I think that the strategy we've seen to date has been quite unrealistic, delusional, as you put it. And where we end up is maybe a higher tariff regime, maybe 10 to 20%, slower global growth, an inflation bump, and I think higher risk premium on equities. So whatever was overvalued, I think, has to reset downward, because we are in a more uncertain environment. So we're looking at that sort of 3 to 6 months down the line and saying, where will we settle?
It's just when you think you know everything on the markets, you need to rewrite the textbook. We're in that sort of phase at the moment. But you spoke about debt to GDP earlier, and I think we can bring this back home to South Africa. And this is a metric we find all very interesting. How are we managing our debt? Are we being able to grow? And we've kind of been in this interesting tension for a long time now. And now we have the GNU, which adds another dimension to that. So yeah, keen to hear your thoughts on what's happening locally on that front.
Yeah, so this is something we've talked about for a long time, because we've had this economic stagnation where we've grown by less than 1% for the last decade, which for an emerging market is a terrible place to be in. And when we saw the budget presented, the delayed budget, firstly delayed and then presented later, it was effectively a continuation of the ANC's economic policy, which hasn't been successful. It's basically higher spending, higher taxes, higher debt. And for all of that policy, we've basically increased our debt to GDP ratio from around the 30% level towards the 75% level. It's just consistently gone up since 2010, and we haven't had putting on all this debt, we haven't had much growth to show for it. So this is something we're really concerned about. And when we saw the GNU come into effect last year, we felt it gave us a shot of getting our growth back on track. So as an emerging market, you need around the 3% type growth level, but at least above 2% in order to really resolve this issue. No country can kind of contain its debt or keep its budget under control when you're growing sub 1%. So you needed growth back on, and I think what the GNU gave us some hope was that the parties would come together, primarily the ANC and the DA, the two biggest parties, working together to improve sentiment, to have more positive growth policies. However, as we reflect on the events in the last month, and I think that has been a severe disappointment. The GNU was effectively patched together. I think the ANC has been very vocal about seeing it more as a tactical play, and I don't think we've got the collaboration that the market and investors have hoped for, which means that if you don't have that and people see it as a patched together type of arrangement, you're not necessarily getting that confidence that corporates have on a 3, 4, 5, 10-year horizon to really invest, which is why the growth has really been disappointing. It hasn't come through. And even if the GNU lasts another couple of weeks, months, or until the next election, I think that people have really discounted its impact. And therefore, valuations have really come down, risk premiums have risen, and we haven't really got the impact that we've hoped. And therefore, our debt trajectory has actually continued to grow. So I think it's effectively business as usual, not really a igniting of the growth trajectory for South Africa. And the bond markets and the equity markets have to reflect that now.
Yeah, and then all this movement we're seeing globally. I think you mentioned earlier in our discussion around whether you're a mid, small, large cap company, how do you allocate capital with so much uncertainty because the landscape is changing so quickly. I remember looking at numbers of national, debt, and Italy was this, anemically high debt number now, but we seem to have normalized now where even South Africa and most countries seem to be operating at that level now, if I'm thinking over the last 10 years. So,
yeah, I mean, you mentioned rewriting the textbooks. I remember, years ago, the textbook used to say that the threshold for being in a debt trap was for emerging markets was about the 60% level, for developed markets was the 90% level. So South Africa, we've broken well through that 60. Developed markets are all above 90, the US at 120, the UK sitting at 100. So we are in a risky period where it's very difficult to pull yourself out of it. Austerity, cutting your budget just ends up impacting growth, and debt to GDP, the GDP is your denominator. It's very difficult to when your denominator's falling to actually get your debt to GDP back under control.
And it sounds like an environment for quality companies with a degree of pricing power. And I know that's something that you guys place a lot of value on. So maybe let's go to a forward-looking lens now in terms of how you are positioned. Walter, who interviewed before you, spoke about so much uncertainty. You can't make any decisions with much conviction, but you just got to position the portfolio for, I guess, multiple scenarios.
As I said, we've got to look through a lot of the noise and think about where we'll end up. And I think it will be a more difficult environment. If you're unwinding this tailwind of globalization that benefited consumers with cheaper goods, it benefited corporates because they were able to outsource their manufacturing to the lowest cost entities, be it a Vietnam or be it China. That's unwinding. So I do think we have to look at companies higher on the quality spectrum with quality management who are able to navigate these type of difficult environments and lower debt burdens, because with a bit of inflation bump, with interest rates and risk premiums higher, if you need to be refinancing this week, it's not the time, you've got a massive problem. So lower gearing is what we're looking for. We also took the opportunity before this recent sell-off to, if you look at our global equity position, our domestic equity, trimming back that back, having a little bit more cash available, because it gives you that optionality so that when you see the volatility that we've seen this week, you are able to buy into that. So on the whole, trim back some local bonds, trim back some local equities, trim back some global equities, sit with a little bit more cash, and just have that optionality when you see risk-off periods.
Yeah, to deploy it when the time is right.
Yeah.
Okay. I think we're all out of time for this morning, but Rashaad, thanks so much for joining us and really appreciate your insights as always. We're going to take another short break, and afterwards I'll be joined by Saul Miller as we're moving up the risk spectrum into our high equity balanced fund